Time now to go to James Thorne. He's the Chief Strategist, Senior Portfolio Manager, Caldwell Investment Management. James, thanks so much for taking the time with us.
Thanks, Michael. How are you today?
I'm great. I'm wondering how you're doing with this kind of an investment environment.
I'm doing great. Yeah, this is what we get paid for.
Yeah, great, and the fund does very well, I know that. But, seriously, is it more difficult when geopolitical events can jump up out of nowhere, like the Turkish coup, or maybe something like the Italian banking crisis that I think's got another few legs to go, or maybe it's a central bank announcement that wasn't anticipated, or at least that some of the market hasn't anticipated because they usually take a big reaction to it. How does that change your approach, if any, or at least how do you factor in those kinds of events into your investment strategy?
Well, those are big questions, and let me just step back and so when the way I look at the world, or the way we look at the world, is let's throw a couple of assumptions so you get on the table, so you get where I'm coming from. First off, the world, our economy, doesn't export to another planet, right? So everything's got to balance. Deficits and surpluses have to balance. And if somebody's going to grow, they're going to take that growth away from some other economy or some other firm. And there are two economies that are manufacturing too much and consuming too little. That's China and Germany. So that's the first thing. Number two, our institutions, whether it's the Federal Reserve, whether it's the EU, whether it's NATO, these institutions that were developed after or around World War II are no longer relevant in 2016, and we have to get comfortable with that. I would even lay on top of that the countries in Eurasia that were developed or picked or developed by the French and the English after World War II, around 1914, 1950, or that period. They're no longer relevant. So we're in a period of time of huge flux. And Mike, if you accept that, then you understand that, you know what happened with Turkey, I can't foretell the future, but am I surprised? No. Turkey is has to become a regional power, just like the Ottoman Empire did 500 years ago. Europe and Brexit, everybody now knows it's not about England. It's about the fact that the only country that benefits from the EU is Germany. 50% of their exports, 50% of their GDP is exports, and the only one that's benefited from this experiment has been the Germans. And nobody wants to join the EU. Everybody wants to get out. And Michael, in our lifetime, we are going to have to deal with this because there is no decision-making mechanism in the EU for them to determine anything, whether it's the Italian banks, whether it's the immigration problem, you name it, it is dysfunctional. So if the central banks are fighting the wrong battle, inflation, deflation is the problem, demographics, globalization, and technology are deflationary, and yet the policies that these guys and the restriction that these central banks have been straddled with were developed in the 1970s. So if you understand that this is the case as a global macro strategist, then you understand this, and then it's like sitting there in February in the Midwest, knowing that it's going to be cold, and you pick your spot. So as Warren Buffett would say, when people get greedy, you get fearful, and when people get fearful, you get greedy, and you just continue to maintain your intellectual flexibility and look for opportunities to make money.
It's interesting. I was thinking when you're saying about the EU, it might be a public service if you emailed every one of our political commentariat, with maybe one or two exceptions only, and I get a lot of chance to read. I do make time to read right across the country, and it was amazing to me. On this show, we correctly predicted that the Leave side would win for ages. Never got off that. But for the very reasons you're talking about, I said, no, the EU's the problem here. And it's just funny how our commentary is so entrenched in the establishment way of thinking in a world, as you've just pointed out, that is changing so dramatically. I'm just finding it astounding. And that's the key component for investors is we're in this huge flux, as you say, and then it's how to kind of orient our investments to account for that.
Michael, this is no different than 1905 after Germany reunified in 1871. There was a period of globalization. Germany rose up, became an economic power without any countries. Think about the English Empire. They didn't have any of that, and there was concern. And we had 30 years of war, where 100 million people in Europe were killed. And yet, as we were walking into this period, there were really smart, sophisticated people saying there is no way the French, the Germans, and the Russians are going to go to war because it's going to cost them too much money. Well, boy, oh boy, weren't they wrong. Oh boy, weren't they wrong. But that's, as long as you accept that and recognize the fact that, you know what, German has the weak hand now. And just like in 1914 and 1915, they were asking the question, what is Germany going to do? It's the same question. What's Merkel going to do? I have no clue. I think the difference is, just like using a poker analogy, is if you don't know who the patsy at the table is, then you're the patsy, right? Everybody now knows that Merkel has the weak hand. What are the Germans going to do? Are they going to help the Italians bail out, or what are they going to do? And here's the point where I think you're very profound in thinking this way. We don't know. And the rise of the nation state right now, think about what's happening with Trump in the United States. Think about the far right, that's the five-star movement in Italy. Think about Le Pen in France. Think about just what happened in the UK. This is a huge groundswell. And it's generational, and we have to deal with this as investors. But as long as you understand that, you can pick your spots and you can make money.
Do you have any idea why, speaking of that trend, let's move on to the deflationary trend, which I couldn't agree more with. How have they missed that boat? I mean, that's the problem for Canada, problem, throughout the emerging markets that rely on commodities as the underpinning for their economy. I'm just surprised how it's so tough for people in power, including our central banks, to understand that's the environment we're facing right now.
It's the $64,000 question, because next week we're going to have the Federal Reserve talking, and listen, the last thing the global economy needs right now is the United States to raise rates. What we need is the U.S. dollar to go down, commodity prices to go up, and allow the healing that needs to take place in the emerging markets and to generate economic growth. But I've worked in a large institution before, and I think what happens is, in a large institution, what is common sense gets marred down in the politicking that happens. And make no mistake, the Federal Reserve is a highly, highly political institution. And I would suggest to you the people like Yellen and Fisher come from a period of time where inflation was the risk. Inflation was the big risk. So I'm really concerned that they make the mistake. I'm really concerned that the Federal Reserve is fighting the wrong battle. And if they do, then we have to change our investment process, or sorry, not a process, but our focus really, really quickly. Because if the Federal Reserve starts raising rates, this is not going to end well.
I'm talking with James Thorne. He's the Chief Strategist and Senior Portfolio Manager for Caldwell Investment Management. I'll come back and I'll ask him what kinds of things you should be looking at then in this huge environment full of flux. But we just got more reports this week that the Federal Reserve, the probability is high that they will raise rates. Well, what does that mean to all of us? We'll do that with James Thorne when we come back on the Money Talks Network. Coming up, I got a shocking stat for you, one that I hope you stay with us, because it will shock you. You're sitting down and it's not positive. I also have a Goofy Award. I've been sitting on this one for a couple of weeks. I just dying to get it in. So I said, this is the week. I'll put it in as my Goofy Award. Plus, live from the trading desk, Victor Adair. We've also got Ozzie Jurek. But I'm talking right now to James Thorne. He's the Chief Strategist, Senior Portfolio Manager for Caldwell Investment Management. You can get more information on their funds at caldwellinvestment.ca, but three of them I follow is the Caldwell Balance Fund, the Caldwell Canadian Value Momentum Fund, and the Caldwell U.S. Dividend Advantage Fund. As you know, we've talked about that one simply, well, for a couple of reasons. One is it's well managed, but the other thing is that it's in the U.S., and we're bulls on U.S. dollar here on Money Talks and have been since Canadian was $1.03, so it's not Johnny come lately as some are. But James is the chief strategist, senior portfolio manager. James, before the break, you're doing a wonderful job sort of explaining this kind of environment that we're investing in. And I started right away with, what should we do when central banks kind of come out with policy that seems to change a lot of things? And the one you just alluded to is, what if the U.S. does raise rates? As again, this past week I've been reading that probability is high.
Well, we have this thing called a negative feedback loop. And I think what happens if they start raising rates, given what's going on in the world right now, I would suggest to myself and to you and to your listeners to get defensive, because this is not going to end pretty. This will not end pretty. We will get a credit crisis. We will get a high yield crisis in the United States. We will get an emerging market sovereign debt crisis. This will unravel really, really, really quickly. And I am hoping, and Michael, hope is short, but I am hoping that the Federal Reserve just chills out and goes away. There is no reason right now for them to raise rates. I would argue, though, Michael, there's more reasons for the Bank of Canada to raise rates than there is for the Federal Reserve, in the sense that we've got two big property bubbles going on in Vancouver and Toronto right now. And so what I'm hoping for is that the Federal Reserve lets cooler heads prevail. And I think one of the things your listeners should notice is that what's the subtle things that's happening now is, with all this liquidity that's been pumped into the system, the volatility in the stock market is about historic, but where the real wild rides are in the currency markets and in the fixed income markets. Michael, on Friday, we had a great retail sales number in Canada, a historic number, and yet the Canadian dollar dropped. Why? It was because all of these currency traders that are looking off of these charts that are chicken bones and making this view that the Federal Reserve is going to raise rates, they're positioning. So if the Federal Reserve doesn't raise rates next week, and what we're saying is, and how we've positioned, is that we don't think the Federal Reserve is going to raise rates until after the election. But if they do, then I think you've seen the run. If they don't, and they give a message that's saying chill out, then I would expect to see a significant sell-off in the U.S. dollar, because everybody is positioned for the Federal Reserve to get hawkish. Given what we talked about in the last segment, the best thing that these central bankers could do is go away. Just go away, be quiet, and let the market reach its level. The other thing it needs to do is it really needs to recognize the fact that in 2016 we are on the cusp of a debt deflationary spiral, and if they screw this up, this could get really bad, really ugly. So, Michael, if they raise rates, we have 1937 on the table again. Everybody knows it. Everybody's worried about it. Yellen knows this. Fisher knows this. But will they have the will, and will they have the courage to say, no, we're not going to raise rates? And if that's the case, then it's risk on. Commodities will rally. Money will flow to Canada. The Canadian dollar will appreciate in value, and we'll get a nice risk rally going on into the federal election in the United States. That's what we're hoping for. But yet, at the same point in time, you always have to have your hand on the door to make sure that you're willing to exit these markets if these policymakers make some really stupid mistake because of some political agenda.
Well, it's interesting. You said central banks, Federal Reserve should just go away. I'm hoping they bring the politicians with them. But I think they'll come out this coming week and say we're not raising, but we're going to soon. That's my guess is what they'll say. And I'm not sure where that leaves the market then.
Well, the trade-weighted dollar index, or the DXY, which is what everybody looks at, is at 97. So the U.S. dollar started to appreciate in value when Bernanke started the taper tantrum, and they started to jawbone that they were going to, or communicate that they were going to raise rates. And from that point in time, that dollar index, that trade-weighted dollar index, went from a number of 80 to almost 100. We're at 97 right now. The interesting thing, Michael, is when that was happening, people were assuming that when the Fed raised rates, they were going to raise rates to the historical normal average, which was going to be about 4%. I think that's off the table. So where I'm a little bit non-conventional is the fact that even if they raise rates, they can't raise rates as much as historically they think they can. And on the other side, when you first off, the Bank of Canada and these guys are always behind the curve, right? I mean, last year the Bank of Canada was talking about oil at $75 and $80 when oil was crashing, and they were saying everything was fine. Now they're pricing in, $30 to $40 oil, and the market will correct. And we've got two property bubbles going on in this country right now. And I'm telling you, they are going to have to react to this. I was in Vancouver last week, and I live in Toronto. I was 15 years in Washington, D.C. This is not going to end well unless these guys, the Bank of Canada, starts doing something substantial. Because in Washington, D.C., where I lived, when housing prices start to go down, we see who's wearing clothes, or we see who's over-levered, and we see what really the prices are when all the inventory hits the market at the same time. So I think you may be right, 50-50. I am hoping they say nothing that they're going to raise rates, because if they do, and this is the whole problem, if they talk about this and they talk about raising rates, then the market will discount this ahead of time and we will get a significant correction. And I hope the Federal Reserve has learned their lessons to be quiet, to chill out, and to go away. But if they communicate that they're going to raise rates in September, then risk off.
Great stuff with James Thorne, Chief Strategist, Senior Portfolio Manager of Caldwell Investment Management. You can find him at caldwellinvestment.ca, caldwellinvestment.ca. James, thanks so much for finding the time. Terrific stuff, very important for people to hear. Hope we can visit again in the near future.
Thanks a lot, Michael. Have a great day, everybody.